Is the tech sector headed for a meltdown? Fred Hickey warns of an imminent crash driven by inflated AI hype, while Thomas Fitzpatrick and Mike McGlone detail underlying market risks and potential corrections. Discover why passive investing could be accelerating this crisis. Don't overlook these critical insights that could reshape your investment strategies. Today, on Financial News in Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money. We have is a meltdown in tech stocks nearing as doubts of AI's impact mount. Fred Hickey. From Kitco News, we have warning signs in the equity markets. Small caps and banks underperform. Thomas Fitzpatrick. From David Lynn, we have signs point to market tilt, these assets to sell off first. Mike McGlone. From the Julia LaRoche Show, we have passive investing has turned the market on autopilot. Mike Green. Welcome back to Thoughtful Money, the channel where we dive deep into the financial world's most pressing topics. Today's session is a treat as we welcome Fred Hickey, the esteemed editor of The High-Tech Strategist, a newsletter he has been publishing since 1987. Fred Hickey postulates that we are on the brink of a significant tech stock meltdown, primarily driven by overblown expectations and investments in generative artificial intelligence, Gen AI. He likens the current market sentiment to past bubbles like the dot-com bubble, highlighting inflated valuations and the unsustainable growth rates of major tech stocks that are heavily reliant on speculative AI applications. Here are the key points discussed by Fred Hickey. Topic: Economic and market overview. The global economy is showing signs of weakness with particular strain in China and Europe. In the US, there is a stark divide between the wealthy, buoyed by stock market and real estate gains, and the majority who are struggling financially. Topic: AI hype versus reality. Hickey argues that while AI is real and has long-term potential, the specific hype around generative AI and large language models is increasingly proving to be unsubstantiated. Companies are not seeing the expected returns on their massive investments in AI, with only a small fraction realizing significant paybacks. Topic: Tech stock valuations. The so-called Magnificent Seven tech stocks, including Nvidia and Apple, are disproportionately buoying market indices, reminiscent of the 2000 dot-com bubble. These companies have seen astronomical increases in market cap without corresponding substantial growth in underlying business performance. Topic: Market dynamics and risks. Narrow market breadth. A small number of tech stocks are driving market gains, while broader market indices and smaller stocks lag. Historical comparisons. Market behaviors today are being likened to past speculative bubbles, where valuations far outstrip realistic business metrics. Fred Hickey made the following predictions. Prediction: Major tech stock correction. Hickey predicts a significant correction in overvalued tech stocks like Nvidia, which he expects could drop by as much as 80 to 90% based on historical patterns and inflated current valuations. He anticipates a broader market impact as these key tech stocks decline, triggering negative wealth effects and potentially accelerating an economic downturn. Prediction: Reallocation to value stocks. In the event of a tech stock downturn, there may be a shift in investment towards undervalued sectors and commodities, including precious metals and value stocks. Fred Hickey concludes by emphasizing the need for caution and patience in an overheated market environment. He suggests that the current tech bubble, driven by unsustainable AI hype, will eventually burst, leading to significant market reallocations and corrections. Hickey advises investors to consider safer investments like U.S. Treasuries and gold. He remains bullish on gold miners, which have not yet reflected the gains in gold prices due to undervaluation and expected improvements in earnings and cash flow. In this insightful episode of Kitco News, host Jeremy Safin explores current trends in the equity markets with Thomas Fitzpatrick, Managing Director of Global Market Insights at R.J. O'Brien and Associates. The conversation delves into the implications of the Federal Reserve's policy decisions, particularly focusing on the underperformance of small-cap stocks and banks. The central thesis presented by Fitzpatrick is that the equity markets are flashing warning signals, particularly through the underperformance of small-cap stocks and the banking sector. He emphasizes that the Federal Reserve's cautious approach is a reaction to past mistakes and that there are significant hurdles the market and economy need to navigate in the forthcoming months. He suggests that while headline indices like the NASDAQ show positive signs, the broader market, represented by indices like the Russell 2000, reveals deeper concerns. Here are the key points discussed by Thomas Fitzpatrick. Topic: Fed's policy and market impact. Federal Reserve Chairman Jerome Powell announced only one potential rate cut for the rest of the year, despite rising unemployment and mixed economic data. The Fed's cautious stance is driven by a desire to not repeat past mistakes, such as the rapid fiscal stimulus in 2020 to 2021, which fueled inflation. Topic: Comparative historical insights. Fitzpatrick draws parallels between the current market situation and the year 2000, highlighting similarities like the tech-driven market rally and the Fed's tightening monetary policy back then. He notes, however, the absence of an overriding factor like the oil price surge in the 1970s. Topic: Sectoral performance. While major indices like the S&P 500 and NASDAQ have been performing well, smaller indices such as the Russell 2000, regional bank indices, and the Dow Jones Transports show significant underperformance. This underperformance suggests weaknesses in the market that could signal broader economic challenges ahead. Topic: Employment and inflation dynamics. Fitzpatrick stresses the critical role of the employment picture in shaping future Fed policies, indicating that a deterioration in employment data could prompt further rate cuts. He also notes that while some inflation components have moderated, others like car insurance and shelter costs have kept headline inflation higher. Thomas Fitzpatrick made the following predictions. Prediction: potential for multiple rate cuts. Fitzpatrick speculates that the Fed might have to resort to more than one rate cut if employment numbers worsen significantly, contrasting the Fed's current stance of only one predicted cut for the year. Prediction: possible slowdown in high-flying tech stocks. He suggests that some high-performing tech stocks might face pressure as their current valuations are highly elevated, similar to what happened during the dot-com bust in 2000. Thomas Fitzpatrick underscores the importance of paying attention to underlying market signals, such as the performance of smaller stocks and banks, which are often early indicators of broader economic shifts. He advises investors to consider diversifying their portfolios, possibly focusing on staple goods companies rather than discretionary spending or overly inflated tech stocks. Monitoring employment trends will be crucial, as any further weakening could dramatically influence Fed policy and market outcomes in the near term. In this episode of David Lynn Reports, host David Lynn interviews Mike McGlone, senior commodity strategist at Bloomberg Intelligence. The discussion revolves around the current economic outlook, focusing on market volatility, commodity trends, and the behavior of Bitcoin. The central thesis of the video is Mike McGlone's analysis that the current market conditions are precarious, marked by low volatility, high interest rates, and overvalued equities. These conditions are indicative of an impending tilt towards recessionary deflation. McGlone suggests that risk assets should be underweighted, while safer investments like treasury bonds and gold should be prioritized. Here are the key points discussed by Mike McGlone. Topic: Market conditions. The market is experiencing extraordinarily low volatility amidst high interest rates and expensive equities. Recent elections and economic data point towards a tilt from risk assets to safer options such as treasury bonds and gold. Topic: Economic indicators. CPI disinflation has been observed, but inflation remains sticky due to high stock market valuations. Global bond yields, such as the 10-year Chinese government bond, are increasingly lower compared to U.S. yields, indicating a tilt towards global deflation. Topic: Commodity trends. Raw materials like copper and crude oil have peaked, while gold is positioned to make gains amidst current market conditions. Natural gas, crude oil, and grains are witnessing falling prices, driven by increased supply and reduced demand. Topic: Stock market sentiment. Despite bullish projections from firms like Goldman Sachs, McGlone argues that the stock market's high valuation relative to GDP is unsustainable. The stock market's low volatility index, VIX, is similar to conditions preceding the 2008 financial crisis, signaling a potential downturn. Mike McGlone made the following predictions. Prediction: stock market correction. McGlone predicts a significant correction in the stock market is imminent, triggered by declining economic indicators and high market valuations. This correction would be a normal reversion following an unprecedented money pump into financial markets. Prediction: commodities deflation. Commodities such as crude oil and copper will continue to experience falling prices. Gold, however, is expected to rise to levels around $3,000 as it benefits from shifts in global economic policies and inflation trends. Prediction: Bitcoin volatility. Bitcoin will likely lead the way down in risk assets due to its speculative nature and recent underperformance against traditional market measures like the Nasdaq. Mike McGlone emphasizes the necessity of adjusting investment strategies to account for an impending market correction. He advises caution in risk assets and favors investment in treasury bonds and gold, predicting a downturn rooted in fundamental economic shifts. The central call to action is to prioritize safety and prepare for the inevitable reversion in financial markets towards stability and lower valuation. Welcome back to the Julia LaRoche Show, where today we're diving deep into the intricacies of passive investing with Mike Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. As a seasoned expert touching on macroeconomic realities and market dynamics, Mike brings years of experience and insightful perspectives that help us understand how passive investing is shaping today's financial landscape. The core focus of Mike Green's discussion revolves around the profound impact of passive investing on market dynamics. He posits that the growth of passive investing strategies has turned the market onto a sort of autopilot, wherein mechanical, rule-based investment flows dominate over thoughtful, discretionary investment decisions. This shift has led to a bifurcated economy where those without assets struggle to accumulate wealth, exacerbated by increasing difficulties in financing and rising asset prices. Here are the key points discussed by Mike Green. Topic: Mechanics of passive investing. Passive strategies, particularly market cap-weighted indices like the S&P 500, are replacing traditional active management. Market behavior is increasingly driven by flow-based dynamics, with contributions to 401ks and market cap-weighted index funds affecting stock prices irrespective of underlying fundamentals. Topic: Market bifurcation. A very few large-cap technology stocks are seeing significant upward movements, while many smaller stocks within indices like the Russell 2000 are underperforming. Passive investing and corporate share buybacks are amplifying this divergence, concentrating gains among a select few. Topic: Economic inequality. Boomers benefit from rising yields on their fixed income investments, while younger generations find it increasingly difficult to afford homes and accumulate wealth. The disparity in economic benefits is creating a sense of nihilism and frustration among younger generations, leading to behaviors like short-term, high-risk investments. Topic: Structural employment changes. Post-pandemic, many higher-end workers are turning to gig economy jobs like Uber, driving to supplement their income, influencing unemployment dynamics and skewing data policymakers rely on. Mike Green made the following predictions. Prediction: Market corrections. Given the inelastic nature of large-cap stocks, market corrections could be dramatic, particularly if funds begin to sell off their holdings. The dependence on continuous inflows to sustain price levels means any significant outflow could cause accelerated declines in stock prices. Prediction: Retirement wealth erosion. The presumed retirement wealth, largely tied to inflated stock market valuations, could face significant reductions, particularly as baby boomers begin drawing down their 401k assets. This poses a threat to the perceived stability and adequacy of retirement funds. Mike Green concludes by emphasizing the need for a more thoughtful approach to retirement planning and investing. The reliance on passive strategies and the unrealistic valuation of assets mean both investors and policymakers must prepare for potential market corrections and the economic impact of mechanical investment flows. Calls to action include diversifying investment strategies and critically examining the broader economic implications of current market behaviors to ensure more sustainable financial planning. Across these discussions, experts agree on significant market vulnerabilities stemming from overvalued tech stocks and passive investing's dominance. Fred Hickey predicts an AI-driven tech bubble burst, while Thomas Fitzpatrick and Mike McGlone highlight broader economic signals and potential sectoral shifts. Despite differing in specific triggers and timelines, all stress a cautionary approach and support diversifying into safer assets like treasury bonds and gold. The impending market rebalancing calls for vigilant strategy adjustments. Prepare now to navigate the turbulent waters ahead. Thanks for watching Financial News and Review for Tuesday, June 18th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see, drop a comment below. See you next time.